Hello, welcome back. So, in a continuing from the last uh, video segment, we we already understand this close connection between index model and cap, and basically what is uh, the practical or operational form of the other. Actually, the index model is the operational form, but in a hypothetical equilibrium, and I said capm is an equilibrium model because if that what that means is if the asset is in equilibrium, right? Uh, uh, it it would fall exactly on uh, the security characteristic line, and basically, CAPM uh, uh, predicts, what the expected return that would fall on the security SCL, security characteristic line. Um, and I mentioned that the security market line, okay, security market. Um, but so in a hypothetical equilibrium, risk premium on the passive market portfolio is supposed to be proportional to the variance of the yeah variance of the market portfolio. And what that means is the high, to put it in a another way, uh, the higher the return, the higher the risk, the higher the return, right? The higher the variance, the higher the excess return, right? And that's not the only factor, right? That's not the only element. Um, and it's also proportional to the investor's typical degree of risk aversion, right? Of course, um, uh, so the market risk premium is basically excess return on the market, right? And then it's not only the function of the variance, but also uh, the average price of risk, right? Uh, Typical degree, that means invest average uh, risk aversion of the investors, right? Average uh, investors. So if and the demand will bid up the prices, and then expected return um, will lower the risk premium. Yeah, as the price goes up, right, the return will go down, right? As the current market price goes up, the return, expected return will go down. When premiums go down, investors move funds into the risk-free asset. Yeah, uh, and there is no reason if the return on the stocks go down, there is no reason for any investor to stay locked in a stock. They would rather move. Uh, of course, when uh, expected return falls significantly. I mean, as long as the expected return is still above the risk-free return, yeah, that's the reason for it justifies keeping your position in the stock. But if it falls, as it falls more and more, then some of the funds will move to risk-free asset. In equilibrium, market risk premium must be just high enough to induce investors to hold the available stock, a supply of stocks. Yeah, that's what it means. Uh, Suppose risk-free return is 5%, average, risk aversion. Now you understand why they use symbol A for price of risk, because that's, price for the uh, uh, risk aversion, right? The compensation for taking that risk. Normally, if my risk aversion is 2, then the return should justify that. Uh, that's the price that the return. The market has to pay, or the stock has to pay, right, to induce my uh, uh, for me to overcome my risk aversion, and uh, to invest in that stock. So anyway, if that's the case, and if the standard deviation is 20% of the market is 20%, uh, what is the excess what would be the equilibrium uh, market premium? Then of course, then it's going to be just like this, 2 times variance, which would be zero point 0.4, right? So that uh, it will be uh, 0.04, right? And it will have to be a 0.08. And then that's the risk, only the market risk premium, right? Uh, so and you see, this is expected market return. It's lowercase. Lowercase means this is not the risk premium. Risk premium is this minus this, right? This minus RF, and then it would be exactly uh, uh, 8%, but uh, expected return on the market is uh, the risk-free rate plus market risk premium. Hence, it will have to be 13%, and this is uh, you know there's no it's indisputable. There's no need to discuss further, why uh, uh, this is the case. It's quite self-explanatory. Now, so capital, we know that the capital allocation line, which is tangent on uh, uh, the efficient frontier, uh, is and is called capital market line. Capital market line basically graphs risk premium of efficient complete portfolio as a function of uh, standard deviation, and the passive portfolio M, or the market portfolio M, on the efficient frontier represents the optimal risky passive portfolio that is tangent on the capital allocation line, hence, capital market line, which is the best attainable CAL. Now, So the passive strategy is, we all understand the passive strategy is efficient. Let me just check what was that link. Yeah, it was nothing but what we already have. This link is actually taking you back to this slide. I was wondering. So when alpha is 0, then there exists no reward from firm-specific risk. Yes, that's, we already alpha of a particular stock is 0. There exists no reward. So then the systematic risk is the beta is the only way to earn return that is greater than the risk-free return. And the market portfolio proportions, which are the result of buy and sell orders that cease to exist if and only if there exists no more profit to be made. Therefore, passive investor benefits from the efficiency of the market index portfolio, right? And however, in real world, risky portfolios may differ from the market portfolio due to differences in each fund manager's estimates of the standard deviation and the expected return. Nevertheless, market index is a reasonable first approximation to efficient risky portfolio. Yes. Again, the controversy maybe, how can everyone reach a consensus that, market portfolio is the efficient. I mean, market portfolio is efficient. That goes without saying. But how can everyone agree on a market portfolio? Well, again, there may be some, recalibration or minor adjustments needed because, as each portfolio manager would have different. Depending on their security quality of their security analysis, they may have slightly different estimates or input data, right? But overall, after making recalibrations and some adjustments, it goes without saying, that a market index is a reasonable first approximation of the efficient risky portfolio. So then if that's the case, passive strategy is sufficiently efficient. Why active strategy if passive strategies cost less than efficient? Well, nevertheless, notwithstanding, security analysis is what brings about the efficiency of the market portfolio. Think about it. By doing the security analysis, right? Which one has alpha? Which one has, doing, through this, eventually market portfolio becomes efficient because if there is any positive alpha stock, and you will only know if any stock has positive alpha or negative alpha through security analysis, and as a result of security analysis, you will hold active portfolio on top of the passive portfolio, and active portfolio will eventually lose its advantage, right? As we discussed, demand will push down the push up the price, and sell off will push down the price. Eventually, there will be no more profit opportunity, then which will all equalize in a passive market portfolio. So um, the efficient market portfolio is the result of actually security analysis and active portfolio. So that investors hold active portfolio that differ from M market portfolio does not invalidate capm. Differences in investors' personal, because investors, each investor would have different uh, personal tax considerations, and then non-traded assets. There are non-traded assets such as human capital, which is uh, basically a particular. Why is Apple such a why is Google, why is Tesla, why are these companies such uh, uh, a market stellar market leader? It's not only the top management, it's not only the capability of the abilities of the top management. They are able to recruit uh, top-notch human capital, right? Um, you might say also Amazon, right? Look, Amazon, you might wonder, it's just I mean, Jeff Bezos, obviously must be a smart person, right? Uh, uh, Otherwise, Amazon couldn't have grown into this, giant, even dinosaur, monster. uh, but the business model is fairly simple. I mean, you're a centralized distribution system. Big warehouse, and then fast um, uh, logistics. So it it doesn't require it seems like other than Jeff Bezos, there's no rocket scientist involved in this business model. It's not like a high tech industry. Um, it's basically delivering the merchandise. Um, yeah, on a very low level, it's just delivery truck drivers. But then think about it. To make the logistics, uh, by far, that simple business model to um, out, outdo their competitors. Obviously, uh, uh, top-notch middle management people have been recruited, right? In other words, uh, how do you retain? How do you recruit and retain, highly qualified people? Uh, Smart people definitely have good uh, uh, college education, good even postgraduate education, right? Graduate education, not only undergrad education. How do you recruit them and retain them? You pay them good money, right? And then if you're being paid good money, you can't quit the job. It's simple as that. Of course, there is certain, exploitation, on Amazon warehouse. How the on the lowest level, on low level, of course they are being exploited. But these are people who have no, college degree, um, I'm not saying it justifies, just because they don't have college degree or uh, just uh, manual labor and unskilled labor. I mean, it would require certain level of skillfulness, to be even working in the warehouse. Obviously, it requires uh, job uh, on the job skills that you learn on the job. But what I'm trying to say is, uh, although it doesn't require a lot of smart people on the lower level, but at least from middle management and upward, it requires a lot of well-educated, smart people to for any company to stay relevant, not just relevant, but stay ahead um, in the industry, right? But think about it. Those uh, human capital, right? Non-traded assets such as human capital. Um, because of those slight differences, right? Still, there's a reason for alpha, and that's why investors still hold active portfolio, right? But of course, eventually alpha would wear out. I mean, when I say wear out, due to uh, the market forces, right? Demand. Uh, uh, Alpha would, wear out very, thin, right? The active portfolio, reasonably well diversified portfolios shed almost all firm specific risk and bear only systematic risk, right? Uh, Even if one does not hold precise market portfolio, a well diversified portfolio will be so highly correlated with the market that a stock's beta still will be a useful risk measure. So, all of these are so far, in a way, theoretical justifications for capm. Um, but obviously, we need to familiarize with these theoretical uh, underpinnings, or theoretical backgrounds and arguments, to be uh, who knows, at some point you might need to uh, you might be engaged in a heated debate about usefulness of about CAPM, and without, I mean, you would need these theoretical underpinnings to carry out that a conversation, or if it is a argument, even academic debate, you will need things to say, why, justification for. And I'm definitely, as an academic, of course, critique, a lot of critique about Kaplan. Still, uh, uh, you can't ignore uh, the that the powerfulness, single-handed, the ability to single-handedly, right, explain the uh, the relationship between market and individual stock, right? That's a very powerful tool. In other words, what is powerful? Um, I mean, if you have to use, three variables to explain one outcome, is it more powerful than explaining one outcome by using one explanatory variable? Which one is more powerful, do you think? Of course, the latter is more powerful. Why? Because if you can explain, um, if there is just one explanation for everything, right? Isn't that very powerful, right? And if you have to um, use so many, explanatory variables to explain just one outcome, that's not a powerful model, right? Of course, if you use three variables to explain one outcome, it may lead to more precise and more accurate uh, result. But you know, uh, think about it. If you use three variables to explain the same outcome or better outcome, but that betterness, I mean, the accuracy and precision of that outcome must be three times, at least three times, the accuracy and precision of the outcome when you use only one explanatory variable. Make sense? Right? In other words, yeah, this is very basic rationale, very basic reasoning, right? Um, if you use three times, if you have to spend three times more money to do the same thing, right? Uh, then using three times more money than using only one, uh, you know, uh, 1/3 of that amount, right? Which one is more? Which one is a better business model, right? I mean, if you're building a structure, if you build a building, right? Uh, uh, if you're building Empire State Building, and one contractor says it costs $30 million to build, another contractor says it costs one 10. Did I say $30 million? And $10 million. And of course, you might say, oh, then if it costs only 1/3 of the money, then the building material, quality of building material, and probably structure may not be as uh, stable or no, no, ignore. Let's assume that it's all the same quality, all the other factors being equal, ceteris paribus, right? Uh, which one is more powerful? Which contractor will get the win the project? Of course, the one, if as long as the quality of the building, all the other factors are equal, building material, quality of the building material, uh, uh, you know, um, uh, structural stability of the building. I mean, the only explanation that can explain the difference is the technology being used is more, more advanced. Otherwise, it cannot cut the cost like that. I mean, it's just the same idea. If you use just one explanatory variable to explain the same outcome, right? Clearly, it's a more powerful model, right? Makes sense. I mean, if you have to spend, if it costs $30 million to build the same building, the building should be three times better, right? I mean, in a quantifiable way, it should be better. Three times taller or three times more. Uh, the building material should be, three times more uh, fancier or better. In other words, um, so that's why capm is still, a very powerful model. Of course, you will see later that there are multi-factor models. Multi-factor models may result in a more accurate prediction, or more accurate forecast. Uh, but are we getting that improvement in precision and accuracy is not uh, worth the cost. Cost, what is cost in a forecasting model? But you have to, once again, if there are two more variables, then you have to uh, uh, collect the data for two more variables, right? And also, I mean, collecting two more, sets of data may seem not much of a trouble, uh, but still, it's more, it's adding more cost, right? Now, and so this is nothing, new. Risk premium on individual asset is expressed as it's also proportional to the market risk premium, and it's proportional to beta. And each investor uses market portfolio for optimal risky portfolio. Uh, uh, Capital allocation line in this case is capital market line, and expected return on individual securities. Uh, of course, if you use uppercase, that's premium, right? Risk premium or excess return. It will be proportional to beta, which is called this one is important. I mean, no, later on in the slide, you will see, equation 7.2, equation 7.3, 7.4, and when I refer to equation 7.2, and when we are, way past this slide, way after this slide, referring to equation 7.2, you might which one? You might wonder which one was that. You might not be clear. So at least let's make it clear that this is what we call equation 7.2. I mean, it's just for uh, convenience. I mean, that's not the official name of this equation, but the official name of this equation is what? It's capm, right? The official name of this equation is the official name of this equation is capm, of course. And now it's subscript. From the subscript, you can tell it is about this del, right? Now the security market line. I've been talking about, I've been trying to make distinctions clear to you from chapter 5, and pretty much similar concept, but horizontal axis, on the horizontal axis, it is beta in a security market line. It's the horizontal axis is beta, whereas capital allocation line or capital market line, the 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 horizontal axis is uh, uh, standard deviation, okay, or variance. Now we're going to be we're out of time, so uh, we'll continue on in the next video from the security market line. Okay, so that's it for now. I'll see you guys in the next video, and stop recording.